Hello everyone, welcome back. Today we're going to be talking about deficit spending and public debt. So, the government budget deficit exists if the government spends more than it receives in taxes or other revenues during a given period of time. The government budget deficit is financed by the selling of government securities, like bonds, basically. The federal deficit is a flow variable. One usually defined for a specific period of time, like a year. If spending equals receipts, then the government budget is balanced, and if this receipts, or what they take in, exceeds spending, then the government is running a surplus. A balanced budget, we just talked about that, is a situation in which the government spending is exactly equal to the total taxes and revenues it collects during a given period of time. And a surplus is where it exceeds the government spending during a period of time. It's important to note that government debt, or public debt, is a stock variable. The total value of all outstanding federal government securities is the debt. Since 1940, the U.S. federal government has operated with a budget surplus in only 13 years. In all other years, the shortfall of tax revenues below expenditures has been financed with borrowing, which creates the debt. So here is the difference between spending and revenues or receipts. And you can kind of see in, I think, the 1998 or so is when the first, the surplus occurred, right? And then you have one also right after World War II. And this is the federal budget deficit as a percent of GDP, which is pretty large. And just note what the axis on the left there. So why has the government budget recently slipped from a surplus of 2.5% of GDP into a deficit of more than 8% of GDP? Well, that's kind of a complicated question, but you can kind of simply say spending has increased at a faster pace since the 2000s, and tax rates were reduced towards the end of the recession. So there were kind of two forces that influenced it there. Gross public debt is a sort of different way of categorizing debt than net, which we'll talk about both. Gross public debt is all federal government debt regardless of who owns it, and net public debt is gross public debt minus government interagency borrowing. So some government's bonds are held by government agencies. In this case, the funds are owned from one branch of the federal government to another. To arrive at net public debt, we subtract interagency borrowings from this gross public debt, from the whole thing. Tax revenues tend to be stagnant during times of slow economic growth. Tax revenues grow, though, more quickly when overall growth is bringing up income, right? Like a rising tide that buoys all ships. As long as spending exceeds revenues, the budget deficit will persist. Oh, I think I skipped. Nope. During World War II, the net public debt grew dramatically. But after the war, the net public debt fell until about the 1970s, and then started coming back up again in the 80s, and then fell back again in the 90s, and recently it's been coming up again. Here's kind of a nice table going through all of the federal deficit. And here's another graph showing the official net U.S. public debt as a percentage of GDP. I think the one we saw before was just gross debt, so this one is net. The government must pay interest on the outstanding public debt eventually. The level of these payments depends, though, on the market interest rate. Interest payments as a percentage of GDP, though, are likely to rise in the future. If the economy is already at full employment, then further provision of government goods will crowd out some of the private goods. So this is kind of talking about how public debt may rise and kind of affect us there on out. Deficit spending may raise interest rates, which in turn will discourage capital formation in the private sector. Crowding out may place a burden on future generations because increased present consumption may crowd out investment that we just talked about and reduce the growth of capital goods, which could therefore reduced economic growth in the future, which can affect future generations' wealth levels. Taxes may have to be increased also, which imposing higher taxes on future generations would help basically reduce the debt. Paying off the public debt in the future, if the debt becomes larger, then each person's share of the debt will go up. Taxes would be levied and might not be assessed equally. A special tax could be levied based on a person's ability to pay. It's possible. It's one way of tackling the debt. If deficits lead to slower growth rates, then future generations will be poorer, right? We kind of talked about that quickly before. Both present and future generations will be economically better off if the government expenditures are really investments. So if they're not just spending, but investments that pay off in the future, it could be that the debt may help future generations. And they may be better off if the rate of return on such public investments exceeds the interest rate paid on the bonds. And here is a nice graph of different trade deficits or federal budget deficits. So here's more implications for economic performance. As the government borrows funds to finance the deficit and domestic private consumption does not decrease, some of these funds will be borrowed from foreigners, right? You have to finance it somehow. The interest rate paid on bonds will need to be high enough to attract foreign investors, though, so that further would put pressure on the interest rates to increase. So how do higher deficits affect the economy in the short run, though? Well, if the economy is below full employment, the deficit can close the gap. If the economy is already at full employment, then the deficit can increase inflation. But what are the long-run macroeconomic effects of a higher budget deficit? In the long run, higher government budget deficits have no effect on equilibrium real GDP per year. Ultimately, therefore, government spending in excess of government receipts simply redistributes a larger share of real GDP per year to government-provided goods and services. So then if government operates with higher deficits over an extended period, the ultimate result is a shrinkage in the share of privately produced goods and services, kind of from that crowding out effect we talked about. So by continually spending more than it collects, the government takes up a larger portion of economic activity. And here's another graph of spending and different things that the government spends its money on as a percent of its total expenditures.